Why crypto jumped. August 19, 20th, 2026 price rally explained. On August 19th and 20th, 2026, crypto prices moved sharply higher. Bitcoin pushed from the mid-60,000 area toward the low 70,000 area. Ethereum recovered above $2,000, and crypto-linked stocks reacted with big gains. The move looked sudden, but it was not caused by one single thing. It was the result of several forces arriving at the same time. Relief in the bond market, a weaker dollar tone, optimism around United States crypto regulation, ETF demand, and a short squeeze that forced traders to buy back coins they had been betting against. The first catalyst was macro. The United States Treasury announced an expanded plan to buy back long-dated government debt. Investors interpreted that as an attempt to calm stress in the bond market. When bond yields ease, the dollar can soften and risk assets often catch a bid. Bitcoin benefits from that environment because some investors see it as a scarce digital asset that becomes more attractive when confidence in traditional debt markets is being questioned. The second catalyst was market structure. A large amount of short positioning had built up during the previous decline. When prices started rising, leveraged traders who had bet against Bitcoin and Ethereum were forced out. Exchanges and brokers automatically closed those positions, and closing a short means buying the asset back. That can turn a normal rally into a fast vertical move. Reports on August 19th and 20th describe billions of dollars of crypto shorts being liquidated within a short period, with Bitcoin and Ethereum seeing the biggest impact. The third catalyst was policy. A White House meeting with crypto industry leaders and renewed discussion of the Clarity Act gave the market a reason to price in a friendlier regulatory environment. Crypto markets do not only move on technology. They also move on whether banks, funds, exchanges, and developers believe rules are becoming more predictable. Clearer rules can reduce the fear that a business model will be blocked later, and that can attract more institutional capital. The fourth catalyst was institutional demand. Spot crypto exchange-traded funds have made it easier for investors to buy exposure without managing wallets or private keys. When price begins to move, fund flows can reinforce the move. At the same time, listed crypto companies, such as exchanges, miners, and Bitcoin treasury companies, often rise faster than the underlying asset because equity traders treat them as leveraged ways to express the same theme. Still, a two-day rally does not automatically mean a new bull market has started. Short squeezes can fade after forced buying ends. Bond yields can rise again. Regulatory headlines can disappoint. Crypto is still a high-volatility asset class where large moves are normal. The correct lesson is not to chase emotion. The correct lesson is to understand the drivers: macro liquidity, regulation, flows, leverage, and sentiment. To understand the rally properly, think about crypto as a liquidity-sensitive market. When traders believe liquidity is improving, they often move first into the highest beta assets. Bitcoin, Ethereum, miners, exchanges, and treasury-style crypto companies can all react quickly. This is why a bond market headline can affect crypto, even though it is not directly about blockchain technology. The timing also matters. Before the rally, many traders had become defensive because Bitcoin had fallen far below its previous highs. When a market has been weak for months, short positions can become crowded. A crowded short trade is unstable. It can look calm until the first strong catalyst forces everyone to exit through the same door. Another important point is narrative. Markets do not only price numbers, they price stories. The story on August 19th and 20th was that Washington might become more constructive toward digital assets. Treasury action might reduce financial stress, and institutional flows might return. When narrative, liquidity, and leverage point in the same direction, price can move faster than fundamentals. For viewers, the lesson is to separate cause from confirmation. A headline may start the move, but price confirmation invites more traders, technical breakouts invite algorithms, and liquidations invite forced buying. By the time most people see the news, several layers of buying may already be stacked on top of each other. A practical checklist for future crypto moves is simple. First, check Treasury yields and the dollar. Second, check ETF flows. Third, check futures open interest and liquidation data. Fourth, check regulatory headlines. Fifth, check whether the move is broad across crypto or concentrated in one coin. Broad moves are usually healthier than isolated spikes. Finally, remember that volatility cuts both ways. The same leverage that pushes prices up can push them down. If yields rebound, policy expectations fade, or EDF flows reverse, the market can give back gains quickly. That is why risk management matters more than excitement. Another useful way to read this rally is through the lens of confidence. Crypto markets are highly sensitive to whether traders feel the financial system is becoming more liquid or more restrictive. When headlines suggest that policymakers are trying to stabilize bond market conditions, traders often assume that risk appetite can improve. That assumption may be right or wrong, but it affects positioning immediately. Bitcoin also behaves differently from many smaller crypto assets. Bitcoin is often treated as the macro asset of the crypto world, a blend of digital scarcity, liquidity proxy, and speculative technology exposure. Ethereum, meanwhile, often reacts to expectations around decentralized finance, stablecoins, tokenized assets, and app activity. When both rise together, the market reads it as broad crypto confidence, not just one isolated trade. The role of media and social platforms should not be ignored. Once a large move begins, headlines, influencer posts, trading dashboards, and liquidation screenshots spread quickly. That feedback loop can bring late buyers into the market. In a thin or highly leveraged market, new buying can make the move look stronger than the original catalyst alone would justify. For a serious investor or creator, the best response is to build a repeatable framework. Ask whether the move is macro-driven, policy-driven, flow-driven, leverage-driven, or adoption-driven. A durable rally usually has more than one support. A fragile rally often depends on one headline or one wave of forced liquidations. The final point is emotional discipline. Crypto rewards patience more than impulse. A viewer should not hear that prices rose and immediately think the opportunity is gone or guaranteed. Instead, study the structure, identify support on resistance, understand catalysts, and decide whether the risk fits your own plan. So the reason crypto rose on August 19th and 20th was the combination of Treasury-driven market relief, a softer dollar mood, optimism about regulation, ETF, and institutional interest, and a major short squeeze. For creators, investors, and business owners, the useful takeaway is this: crypto does not move in isolation. It sits at the intersection of finance, policy, liquidity, technology, and human psychology. This video is for education only, not financial advice. Always do your own research before buying, selling, or holding any crypto asset.